the morning after Black Monday. I've been stacking physical silver for 12 years now, and I've run commodities analysis for private clients long enough to know when the script has flipped. This morning, looking at the data from yesterday, January 26th, 2026, I'm watching something I've never seen before. Not a crash, not a spike, something stranger. An eerie silence in the numbers. Gold sitting at $5,076.95 bid. Silver at $112.92, up 9.55%. Platinum and palladium punching through 2,800 and 2,100 respectively. And the financial media, they're calling it a volatile commodity spike, a temporary short squeeze in AI-related metals. They want you to look at these numbers and see a bubble. They want you to believe the system is fine, that we're just seeing some froth in the precious metals market, maybe a little speculative fever that'll cool off by next week. They want you to look at the gold price and as the bubble. But here's what they're not telling you. The real story isn't about metals going up. It's about the dollar going down, not just losing value, liquefying. The bedrock of the global financial system is turning to quicksand in real time. And the only people who seem to notice are the ones actually holding physical metal. The mainstream media is calling this a metals crisis. By the end of this video, you'll realize it's actually a dollar funeral. And the music is just starting to play. Let me lay out the primary thesis here, because this isn't about being dramatic. This is about looking at verifiable data and calling it what it is. The dollar's reserve status has officially hit terminal velocity decline. In the year 2000, 65% of the world's reserves were held in US dollars. Today, 40%. That's a 25% drop in just over 2 decades. This isn't a gradual shift. This is a structural collapse. And here's the part that makes no sense to most people. Gold just hit $5,000 while the DXY, the dollar index, remained relatively stable. You're probably thinking, wait, if the dollar is collapsing, shouldn't the DXY be crashing? That's the paradox. That's the illusion. The DXY measures the dollar against other fiat currencies, the euro, the yen, the pound. When all the boats are sinking together, the dollar index can look perfectly calm even as the entire flotilla goes under. It's not strength, it's managed debasement across the board. What gold is telling you, what silver is screaming at you, is that this managed debasement is accelerating. The real measure isn't dollar versus euro. It's dollar versus the only asset that can't be printed, debased, or politicized. So here's my promise to you today. I'm going to break down the mechanism that proves the price on your screen is a lie. I'm going to walk you through the math on VanEck's $184,000 gold model. Not as fantasy, but as a rational endpoint if gold fully remonetizes. And I'm going to share my personal battle plan for when the turbocharger officially engages. Because right now, we're still in the warm-up phase. But before we look at this $5,000 gold, we have to understand why the price on your screen might actually be a paper promise that can never be kept. Let's pull this apart. Because if you don't understand this mechanism, nothing else I'm about to show you will make sense. It's called the paper versus physical decoupling. Simple definition. This is what happens when the digital price of a metal on Western exchanges, like the COMEX in New York or the LBMA in London, no longer reflects the actual cost to acquire a physical bar. It's the moment the IOU system breaks. Think of it like this. You have a concert ticket with a face value of $113. That's the spot price, the official number you see on the screen. You show up at the stadium, ticket in hand, ready to get in for your $113. But when you get to the gate, the gatekeepers are demanding $134 just to let you in. The ticket isn't the show, the seat is. If you can't actually get in for $113, that ticket is just a useless piece of paper. The official price becomes meaningless the moment it stops matching reality. That's what's happening right now in the precious metals market. The COMEX and LBMA have been running a fractional reserve system for decades. They've issued hundreds of paper claims for every single physical bar sitting in their vaults. As long as most people are happy to trade the paper, the futures contracts, the ETFs, the digital entries, the system works. But the second everyone tries to take delivery, to actually get their hands on the physical metal, the whole thing collapses. And we're starting to see the cracks. Here's why this matters today, not 5 years from now. There are reports coming out of Japan of physical silver trading at $139. Let me say that again. While the spot price in New York is showing $112, dealers in Tokyo are moving physical metal at $139. That's a 24% premium. The face value ticket system has shattered. Now, I've been watching this market for 12 years, and I've seen premiums before. During the COVID panic in 2020, we saw premiums spike on silver eagles, on certain coins. But those were retail premiums on specific products. What we're seeing now is different. This is industrial scale premiums on base bullion. This is the wholesale market starting to fracture. Here's the trap most people don't see coming. The paper markets have been used to suppress prices for 2 decades. When physical demand was low, the paper tail could wag the physical dog. Banks could dump futures contracts, create artificial selling pressure, and keep the lid on. It worked because most investors never wanted the actual metal. They just wanted exposure to the price. But when the paper price and the physical price diverge this violently, someone is about to be left holding an empty bag. And it's usually the person who trusts the official ticker. Let me give you the exact snapshot from 11:40 a.m. Eastern yesterday, because precision matters when you're trying to cut through the noise. Gold, $5,076.95 bid. $5,077.63 ask. Silver, $112.92, up 9.55% on the day. Platinum, $2,844.35. Palladium, $2,141.77. All-time highs across the board. Historic moves. The kind of numbers that should dominate every financial headline, every trading floor, every investment committee meeting. And yet, the dollar index barely moved. That's the disconnect I need you to see. The DXY isn't crashing against the euro or the yen because those currencies are sinking too. This isn't about one fiat currency winning or losing against another. This is about all fiat currencies losing against the one asset they can't control. Here's the verified fact that should terrify anyone holding significant dollar-denominated wealth. The USD has lost 50% of its value against gold in just the last 12 months. 50% in 1 year. Let that sink in. If you had $100,000 in cash sitting in a bank account a year ago, that same cash can now buy half the gold it could have bought then. You didn't lose money to inflation as measured by the CPI. That's running at, 3 or 4% officially? You lost half your purchasing power measured in the one asset that matters when currencies fail. Now here's where it gets even more interesting. There are unverified rumors circulating in private dealer networks that physical silver is trading at $134 in certain markets in China. I can't confirm this. I haven't seen the receipts. But if it's true, it means the paper price is lagging reality by 20%. Think about what that means. The screen says 112. The vault says 134. If the world is paying 134 for silver in the East, but the screen says 112 in the West, what happens when the West finally has to pay up? I know what the skeptics are thinking right now. I've heard the argument 1,000 times. It goes like this. The dollar will never collapse because it's the cleanest dirty shirt. Sure, the US is printing money, but Europe is a mess. Japan is drowning in debt. China is a black box. Where else is the world going to go? The dollar might be bad, but it's still the best option. It's called the cleanest dirty shirt theory, and on the surface, it sounds reasonable. But here's the problem with that argument. It's based on a fundamental misunderstanding of what gold is. Gold is not a relative asset. It's an absolute asset. Gold doesn't care if the dollar is stronger than the yen. It doesn't care if the euro is imploding faster than the pound. It only cares that all of them are being printed into oblivion. Let me show you the evidence. Central bank gold purchases hit record highs in 2022. Record highs again in 2023. And the data for 2024 shows the trend accelerating. These aren't Western central banks. These are institutions in China, Russia, Turkey, India, countries that have watched the US weaponize the dollar through sanctions and are quietly building an exit strategy. They're not buying euros. They're not buying yen. They're buying gold. Because gold is the only neutral reserve asset left. It can't be sanctioned. It can't be frozen. It can't be printed. And most importantly, it doesn't require trust in any government or institution. Now let's destroy the second myth. Gold is in a bubble. A bubble is when an asset's price becomes completely detached from its fundamental value. Tulips in the 1600s, dot-com stocks in the late 90s, housing in 2007. Those were bubbles because the assets had no intrinsic value at those prices. Gold at $5,000 is not a bubble. Gold is simply readjusting to its role as the ultimate reserve asset as the dollar's share drops from 65% to 40%. Here's the math. If 40% of global reserves are now outside the dollar, where did that 25% go? Some went to euros, some went to yen, some went to yuan, but increasingly, it's going to gold. And as that shift continues, the price has to rise to absorb the demand. $5,000 isn't a peak. It's a re-rating. The skeptics say the dollar is safe because there are no alternatives. They've clearly forgotten that gold has been the alternative for 5,000 years. Let me run the numbers. All right, let's do a checkpoint here. Because if you've been following along, we've covered 3 critical points. 1, the paper price is decoupling from the physical price. We have evidence of this in the premium spreads between Western and Eastern markets. 2, The USD has already lost 50% of its value against gold this year. That's not a projection. That's recorded history. 3. Central banks are fleeing the dollar and buying gold at record rates. The reserve share has dropped from 65% to 40%. Now let's talk about where this goes next. And I'm going to show you two scenarios, the conservative case and the stress test case. The conservative scenario is based on IMF and Bloomberg data. We know for a fact that the dollar's reserve share has fallen 25 percentage points this century. At $5,000, gold is only just beginning to price in this structural collapse. Why? Because most of that 25% shift happened in the last 5 years. The market is still catching up. If you project the current trajectory forward, another 3 to 5 years, we're looking at the dollar's reserve share dropping below 30%. At that point, gold isn't just a hedge. It's a primary reserve asset for a significant portion of the global financial system. What does that mean for price? Conservative estimate, $7,000 to $10,000 within the next 2 to 3 years. Not as a spike, as a baseline. Now let's run the stress test. This is the Van Eck model, and it's based on a simple question. What if gold had to fully remonetize? What if it had to back a significant portion of the global money supply the way it did under Bretton Woods? The numbers are staggering. Depending on how much of the money supply you're trying to back and what percentage of backing you assume, the target range is anywhere from $39,000 to $184,000 per ounce. Now, before you dismiss that as insane, let me walk you through the logic. Global M2 money supply is roughly $100 trillion. If gold were to back even 20% of that, not 100%, just 20%, you'd need gold prices to rise to approximately $39,000 per ounce based on current total gold reserves. If you go to a 50% backing scenario, you're at $184,000. Is that realistic? I don't know. I'm not predicting it, but I am saying the math works. And the math is based on verifiable data. Total global gold reserves, total global money supply, historical backing ratios. Here's where the turbocharger comes in. Right now, gold is rising against the dollar while the DXY remains relatively stable. That's phase one. We're seeing gold re-rate as a reserve asset while fiat currencies collectively lose value. But phase two, the turbocharger phase, happens when the DXY itself starts to fall, when the dollar finally weakens against other fiat currencies. It acts as a multiplier on the gold price. You get the reserve re-rating and the currency debasement hitting at the same time. If the DXY breaks below 100 and starts trending toward 90, we're not talking about $7,000 gold. We're talking about $10,000 to $15,000 in a very short time frame. When you see the math, $5,000 gold doesn't look like a peak. It looks like a basement. So here's the question everyone wants answered. What happens next? I'm going to give you my read based on 12 years of watching this market and the patterns I've seen institutions use when they're trying to regain control. First, expect margin hikes on the COMEX. This is the oldest trick in the book. When prices run too hot too fast, the exchanges raise the margin requirements for futures contracts. It forces over-leveraged speculators to close positions. It creates artificial selling pressure. It gives the appearance of a correction while the underlying fundamentals haven't changed at all. I've seen this play out in silver 3 times in the last decade. Every time we get a major run-up, the margin hikes come within days. It happened in 2011 when silver hit $50. It happened in 2020 during the COVID spike. It'll happen again. Second, expect media blackouts on physical premiums. You're not going to see CNBC running segments about $139 silver in Japan or $134 silver in China. They'll focus on the spot price. They'll talk about profit-taking and overbought conditions and technical resistance levels. They will do everything they can to prevent a retail stampede into physical metal. Why? Because the system can't handle it. If even 5% of the money currently in paper gold and silver ETFs tried to take physical delivery, the whole structure collapses. The vaults don't have the metal. It's that simple. Now let's talk about the Fed, because this is where it gets really interesting. There are unverified rumors circulating in institutional circles that the Fed has been running internal stress tests on what they're calling a dual failure scenario. What's a dual failure? It's when they can't save both the dollar and the stock market at the same time. Here's the trap they're in. If they raise interest rates to defend the dollar, they crash the stock market and the real estate market and trigger a deflationary spiral. If they cut rates and start printing again to save the stock market, they destroy the dollar and unleash inflation. There is no plan C, and here's the reality check that should wake everyone up. In the year 2000, 65% of the world's money was in USD. Today, it's 40%. This isn't a theory. This isn't a projection. This is recorded fact from the IMF. The world is already de-dollarizing. The only question is how fast it accelerates. So what am I watching? I have 2 triggers that will tell me where we are in this cycle. Trigger 1, the silver premium spread between Asia and New York. If that gap widens beyond 30%, we're in the endgame. That means the paper price has completely lost credibility and the physical market is operating on its own. Trigger 2, DXY support at 100. If the dollar index breaks below 100 and holds below that level for more than a week, the turbocharger engages. At that point, every tick lower in the DXY adds fuel to the gold and silver fire. Here's the hard truth. The Fed is officially trapped. And when they finally make their move, whether it's a rate hike or a rate cut, the metals market will move so fast you won't be able to log into your brokerage. Let me shift gears here and talk about my personal read on this situation. Because I don't do predictions, I do scenarios, and I position accordingly. I believe we are witnessing a seismic monetary shift that happens once every 80 to 100 years. The last time we saw something like this was the breakdown of Bretton Woods in the early 1970s when Nixon closed the gold window. Before that, it was the Great Depression and the end of the gold standard. This isn't a commodity cycle. This is the end of the Bretton Woods era that's been running on fumes since 1971. So here's my conditional plan. And I want to be very clear. This is what I am doing. This is not advice. This is not a recommendation. This is me sharing my personal positioning so you can see how someone with 12 years in this market is thinking about risk. First, I'm watching the $120 level on silver spot. If we break through 120 and hold above it for more than 2 trading days, I expect physical premiums to go so parabolic that I would personally sit on my hands and stop all new physical buying. Why? Because at that point, you're chasing. You're buying into FOMO, and the premiums will be so high that even if spot keeps rising, you'll have overpaid on a percentage basis. I've seen this movie before. The best time to buy is when premiums are low and spot is boring. The worst time to buy is when everyone is panicking and dealers are charging 20 to 30% over spot. Second scenario, if stock futures drop another 5% and we see forced liquidation across the board, hedge funds dumping positions, margin calls hitting, I am looking for a temporary dip in gold back to the 4,800 level. If that happens, I would view that as my final entry point before the next leg up. Why? Because forced liquidation is indiscriminate. When funds have to raise cash, they sell everything, including their winners. It creates short-term dislocations that have nothing to do with fundamentals. Gold dipping to 4,800 in a forced liquidation scenario doesn't mean the thesis is broken. It means someone needed to raise cash in a hurry, and that's an opportunity. Third, I'm holding my current physical positions because I believe the turbocharger hasn't even engaged yet. The DXY is still above 100. When it breaks and trends lower, that's when the real move begins. I'm not trading this. I'm not trying to time the swings. I'm sitting on physical metal that I accumulated over the last 12 years at an average cost basis that looks laughable compared to current prices. And I'm waiting for the moment when the paper price becomes irrelevant because you can't get physical at any price. That's my plan. I know what I'm doing if the market dips. I know what I'm doing if it rips. Do you? Let me zoom out for a second. Because it's easy to get lost in the day-to-day price action and miss the bigger structural shift that's happening. What we're watching right now is the repricing of certainty. For the last 50 years, the US dollar has been the ultimate expression of certainty in the global financial system. You could hold dollars and know, with near absolute confidence, that they would be accepted anywhere, at any time, for any transaction. That certainty was worth something. It was worth a premium. But certainty is evaporating. Every sanctions package, or every debt ceiling fight, every round of quantitative easing chips away at that premium. And when certainty erodes, people start looking for alternatives. Gold is the repricing of that lost certainty. It's not that gold suddenly became more valuable. It's that the dollar suddenly became less certain. And the gap between the two is now widening at an accelerating rate. I want to show you one more piece of data that drives this home. In 2022, central bank gold purchases were 650 tons. In 2023, they were 1,037 tons. In 2024, the preliminary data suggests we're above 1,000 tons again. These aren't hedge funds chasing momentum. These are central banks, institutions that move slowly, that plan in decades, that don't panic buy assets. And they're buying gold at a record pace. Why? Because they see what's coming. They're reading the same IMF data we are. They see the reserve share dropping from 65% to 40%. They know that if they wait until the crisis is obvious, it'll be too late to position. This is the smart money moving quietly before the crowd even realizes there's a problem. The margin hike playbook. I mentioned earlier that I'm expecting margin hikes on the COMEX. Let me explain why this matters even if you don't trade futures. When the COMEX raises margin requirements, it forces speculators to either post more cash or close their positions. Most speculators are leveraged. They don't have unlimited capital. So when margins go up, they close positions. That creates selling pressure in the futures market. And because the futures market drives the spot price in the short term, you get a correction. The media will call it a technical pullback. They'll say the market was overbought. They'll trot out analysts who talk about resistance levels and Fibonacci retracements and all the other astrology that passes for technical analysis. But here's what's really happening. The exchange is trying to cool off the market before it spirals out of control. They're trying to shake out the weak hands before the physical squeeze gets so bad that the whole paper system collapses. I've watched this play out 3 times in silver. Every single time the margin hikes create a short-term dip. And every single time the dip gets bought because the underlying demand for physical hasn't changed. So if you see gold or silver pull back 10 to 15% in the next few weeks, don't panic. Check the COMEX margin requirements. If they've been raised, you're watching the playbook in action. And here's the thing most people miss. The margin hikes only work if the physical market stays calm. If people keep trading paper and nobody tries to take delivery, the system stabilizes. But if the margin hikes trigger a loss of confidence in the paper market, if people start demanding physical delivery in size, the whole thing backfires. Instead of cooling off the market, you accelerate the squeeze. That's the razor's edge we're on right now. Let's talk about why the Asian markets matter so much in this story. Historically, the West has set the price for gold and silver. New York and London were the centers of liquidity. The COMEX and the LBMA were the price discovery mechanisms. If you wanted to know what gold was worth, you looked at the London Fix or the COMEX futures. But that's changing, and it's changing fast. China and India have been building their own physical markets for the last decade. The Shanghai Gold Exchange is now one of the largest in the world. And crucially, it's a physical delivery market. You can't play the paper games there that you can play on the COMEX. If you buy gold on the SGE, you take delivery. That's why the premium spreads matter. When physical gold or silver is trading at a premium in Asia, it's not because of some local supply disruption. It's because the Asian markets are reflecting true physical demand, while the Western markets are still playing the paper game. And right now, the gap is widening. If the reports of $139 silver in Japan are accurate, that's a 24% premium to the New York spot price. If the rumors of $134 silver in China are true, that's a 19% premium. These aren't small discrepancies. These are structural fractures. And here's what happens next. As the premiums widen, arbitrage should kick in. Traders should be buying silver in New York at $112 and shipping it to Tokyo to sell at $139. That's a risk-free profit, right? Except it's not risk-free. Because when you try to actually get physical silver in size in New York, you run into the same problem everyone else is running into. The metal isn't there. Or if it is, the premiums and wait times are so high that the arbitrage disappears. The Asian market is the canary in the coal mine. It's showing us what the real price of physical metal is when you strip away the paper leverage and the fractional reserve games. And that price is a lot higher than what's showing on your screen. There's one more piece of this puzzle I need to address, and it's something most people aren't even thinking about yet. Velocity of money. Right now, the dollar money supply is enormous. We've printed trillions over the last 15 years. But the velocity, how fast that money changes hands, has been relatively low. People have been hoarding cash, paying down debt, sitting on the sidelines. That low velocity has kept inflation in check, or at least it's kept the visible inflation in check. Asset prices have gone through the roof, stocks, real estate, collectibles, but consumer price inflation has been manageable. But what happens if velocity picks up? What happens if people start losing confidence in the dollar and decide they'd rather hold assets than cash? That's when the inflation we've been holding at bay comes roaring back. And it doesn't come back slowly, it comes back all at once. I'm watching for signs of this in the credit markets. If we start to see a surge in loan demand, if we start to see people borrowing dollars to buy real assets, that's the canary. That's the sign that confidence is breaking and people are trying to get out of cash. And if that happens, gold and silver won't just be rising because of reserve diversification or central bank buying. They'll be rising because people are fleeing the currency itself. That's a different kind of move. That's not a re-rating. That's a panic. Let me tell you what I'm seeing from the institutional side. Because while retail investors are just starting to wake up to this, the big money has been positioning for months. First, look at the gold ETF flows. After years of outflows, we're starting to see consistent inflows again. Not huge, not panic buying, but steady accumulation. That tells me that asset allocators are quietly adding gold exposure to their portfolios. Second, look at the mining stocks. The GDX, the gold miners ETF, has been outperforming gold itself over the last 6 months. That's unusual. Normally, the miners lag. But when they start to lead, it means people are positioning for a sustained move higher, not just a short-term spike. Third, and this is the one that really interests me, look at the options market. The skew in gold options has been shifting. More call buying at higher strikes, more demand for upside protection. That tells me that institutions are hedging for a scenario where gold goes a lot higher than current prices. They're not betting on a crash. They're not shorting. They're buying upside optionality. They're saying, I don't know if gold is going to 10,000, but I want to be positioned if it does. That's smart money behavior. That's not speculation. That's risk management. And it tells me that the people with the most information, the most sophisticated models, the most resources are positioning for a scenario where the current price is nowhere near the end of the move. I know what you're thinking. You're thinking, okay, I get the thesis. I understand the mechanism. I see the data. But when? When does this actually play out? And that's the question I can't answer with precision. Nobody can. What I can tell you is that we're already in it. The move from $3,000 gold to $5,000 gold happened faster than most people expected. The move from $70 silver to $112 silver caught the market off guard. We're not waiting for the crisis to start. The crisis is unfolding in slow motion right now. But here's the thing about slow motion crises. They can stay slow for a long time, until they can't. And then everything happens very fast. I've been in this market long enough to know that you can't time the inflection point. You can't know which day is the day when the DXY breaks, when the paper price decouples completely, when the Fed finally blinks. What you can do is position before it's obvious. You can build your positions when premiums are reasonable and supply is available. You can have a plan for different scenarios so you're not making emotional decisions when things start moving fast. The people who win in these situations aren't the ones who time it perfectly. They're the ones who are already in position when the move happens. And right now, with gold at 5,000 and silver over 100, we're still early enough that you can get physical metal. You might pay a premium. You might have to wait a few weeks for delivery, but it's available. That window won't stay open forever. I want to address one more counter-argument because I know there are smart people who will say, what if we get deflation instead? What if the Fed can't print anymore? What if we get a deflationary collapse like the 1930s? It's a fair question, and it's worth thinking through. In a deflationary collapse, cash is king, debt gets destroyed, asset prices fall, and theoretically, you'd want to hold dollars, not gold. Here's why I don't think that scenario plays out. The 1930s were deflationary because we were on a gold standard. The Fed couldn't print unlimited money because dollars were backed by gold. They were constrained. We don't have that constraint anymore. We haven't since 1971. The Fed has demonstrated over and over again that they will print to prevent deflation. 2008, they printed. 2020, they printed. Every time the system has been under stress, they've chosen inflation over deflation. Why? Because deflation destroys the financial system. It makes debts unpayable. It causes cascading bankruptcies. It leads to political instability. Inflation, on the other hand, quietly erodes debts. It benefits borrowers. It keeps the system functioning, even as it destroys savers. So while a deflationary scenario is theoretically possible, I think it's extremely unlikely given the political and institutional incentives. The path of least resistance is always more printing. And if they print, gold goes higher. The setup is historic. Let me bring this all together, because I want to make sure you understand just how rare this setup is. We have a 25% decline in the dollar's reserve share over 2 decades. We have central banks buying gold at record rates. We have physical premiums in Asia suggesting the paper price is 20 to 30% below the real clearing price. We have a Fed that's trapped between saving the dollar and saving the stock market. And we have gold at $5,000 while the DXY is still above 100. This is the setup. The turbocharger hasn't even engaged yet. When the DXY breaks, when the dollar starts falling against other fiat currencies, you're going to see gold move in a way that shocks people. Not a slow grind higher, a vertical move. I've been in this market for 12 years. I've seen corrections. I've seen bull markets. I've seen manipulation. I've seen squeezes. I've never seen a setup like this. The data is screaming at anyone who's paying attention. The reserve share is collapsing. The paper markets are fracturing. The physical demand is overwhelming the supply. And yet, most people are still asleep. They're still listening to the financial media telling them this is just a commodity spike. They're still trusting the paper price on their screens. By the time it's obvious to everyone, it'll be too late to position. Let's talk about the broader implications. Because this isn't just about gold prices or silver premiums or making money on trades. This is about the restructuring of the global financial system. For 50 years, the world has run on a dollar-based system. Trade happens in dollars. Reserves are held in dollars. Commodities are priced in dollars. The entire architecture of global finance is built on dollar liquidity. But that architecture is cracking, and when it finally breaks, we're going to see a mad scramble to figure out what comes next. Will it be a new Bretton Woods agreement with gold playing a formal role? Will it be a multipolar currency system with the yuan and the euro and the dollar all sharing reserve status? Will it be some kind of digital currency framework? I don't know. Nobody knows. What I do know is that the transition is going to be messy. And the people who are holding hard assets, gold, silver, real estate, productive businesses, are going to be in a much better position than the people holding paper promises. This isn't about getting rich. This is about preserving wealth through a once-in-a-century monetary reset. All right, let me wrap this up with my final read on where we are and what I'm doing. I believe the dollar's decline is structural, not cyclical. The reserve share has dropped from 65% to 40% because central banks and sovereign wealth funds have lost confidence in the U.S. ability to manage its debt and its currency. That confidence isn't coming back. I believe the paper price of gold and silver is lagging the physical reality by at least 20%. The premiums in Asia prove this. The delivery delays prove this. The record central bank buying proves this. I believe the Fed is trapped. They can raise rates and crash the economy, or they can print and destroy the dollar. There is no third option. And I believe the turbocharger is coming. When the DXY breaks below 100, when the dollar finally starts falling against other fiats, the gold price is going to move so fast that most people won't have time to react. So here's what I'm doing. I'm holding my physical positions. I'm watching the 120 level in silver and the 4,800 level in gold. I'm not chasing. I'm not panicking. I'm waiting for the market to give me a clear signal. If we get a forced liquidation dip, I'm buying. If we get a breakout above 120 in silver, I'm sitting tight and letting the position run. And most importantly, I'm staying grounded. I'm not getting swept up in the hype. I'm not making emotional decisions. I'm sticking to the plan I built over 12 years of watching this market. That's my play. You have to figure out yours. Let's recap what we've covered. Because this is a lot of information, and I want to make sure the key points are clear. We are witnessing a historic decoupling of paper and physical prices. The evidence is in the Asian premium spreads, the delivery delays, the record central bank buying. The dollar has already lost 50% of its value against gold this year. That's not a projection. That's recorded fact. The reserve share has collapsed from 65% to 40%. The world is already de-dollarizing. The only question is how fast it accelerates. The turbocharger of a DXY collapse is the next major event. When the dollar index breaks below 100, the real move begins. And $5,000 gold is not a peak, it's a re-rating. The math shows that if gold fully remonetizes, we're looking at target ranges between $39,000 and $184,000 per ounce. Here's the rallying cry. The bubble isn't in the metals. The bubble is in the paper promises of a decaying system. The shift is happening now, not next year, not next month. Now, you can see it in the data. You can see it in the premiums. You can see it in the central bank buying. You can see it in the Fed's trapped position. The only question is whether you're going to position before it's obvious or wait until everyone else is scrambling. The situation is moving faster than the headlines can keep up. By the time the financial media acknowledges what's happening, the move will be over. The physical metal will be gone. The premiums will be astronomical. The opportunity to position will have passed. If you want to understand the history of how we got to this $5,000 gold level, if you want to see the 20-year pattern of managed debasement and paper manipulation that set up this moment, you need to go back and watch my previous video on the managed debasement. It'll give you the context you need to understand why this isn't just another bull market, why this is the end of an era. Stay grounded, stay focused. Don't let the daily noise distract you from the structural shift that's unfolding. This is the dollar funeral. The music has started. And by the time the mainstream media admits it, you'll already be positioned for what comes next.